All right, everyone, welcome. This is the continuation of Chapter 5. This is Part 2. So when we last left off, we were still dealing with the accounting challenges that come with purchasing merchandise inventory. And we are the accountants for this company called Z-Mart, right? We're purchasing goods and we sell goods. We just purchased $1,200 of merchandise inventory on account, right? And the credit terms were as follows. So, of course, when we purchase that inventory, we're showing that our inventory has increased an asset by $1,200, and we're showing an increase in a liability by crediting it, right? In one example, we purchased it with cash. Of course, we just show a reduction of cash, also with a credit. In this example, we're buying it on credit, so it's an increase of a liability, which we are also showing here by a credit. This side remains the same. Now we're going to fast forward a little bit into the future. Keep in mind that after this purchase, we owe our supplier $1,200. Keep that in mind that we owe our supplier $1,200, right? So it's November 2nd. Let's assume that is our invoice date when we purchase these goods. So it's 10 days later, right, within the credit terms, and we're going to pay the full amount due from the purchase on November 2nd. Remember, it was $1,200 but that we purchased. This is the old transaction. I'm just recreating it here. We purchased $1,200, but the credit terms had a 2% discount if we paid within 10 days. This is 10 days later, right? And by the way, if it's close, assume we are within the discount period. Most companies wait till the very end of the discount period but do purchase them. If not, they'll wait the entire time because why not keep an interest-free loan going? But so assume if I am even close to the period, go ahead and purchase it. I will never trick you with, hey, that might be 11 days, that might be 9 days, that might be 10 days, based on the counting. If it's close to the credit terms, which it is here, November 2nd we purchased, and November 12th, 10 days later, we are paying for it, assume we get the discount. So let's assume we are getting the discount, but we are paying this amount in full, right? We're paying our account off for the total amount. So the key there is, what did we owe our supplier before? $1,200, right? Now we owe them nothing if we are paying off the full amount, even though we're getting the discount. So to show a reduction in that account payable of $1,200, how do we show a complete termination of that debt that we've paid it? Of course, we would debit the accounts payable $1,200. Now the tricky part is, of course, the discount, right? So we need to calculate it out. What is 2% of the $1,200? I've done the math for you here. It's $24, right? Now that is the discount we're going to get, but where would we put that? Let me go ahead and show you the journal entry here. So I want to walk you through this. Remember, the $1,200 shows that we no longer owe that supplier. We owed him $1,200, now we owe him nothing. We got a discount of 2%, which is $24, so we're not going to pay the full $1,200 in cash, right? We're paying him $1,200 minus 2%, or 98%, which is $1,176. Now, what might seem a little tricky is we are reducing our merchandise inventory account by $24. And here's why, and this is an absolute crucial concept. In the end, remember that we follow the cost principle, right? We record things, including assets, at whatever they cost us, not what they're worth, not what the value is. I don't care that that inventory might be worth $1,200. Heck, it might be worth more or less. What I care about is what it cost me. And I thought it was going to cost me $1,200 when I first purchased it, but I got a discount, right, when we paid early, so it really didn't cost us $1,200. Instead, it cost us $1,200 minus $24. So we're actually adjusting our merchandise inventory down to show that it cost us less and to put a realistic picture of what the inventory is. Don't worry about why, but just follow the concept. So this is what the accounts would look like afterwards, right? And trust me, I say don't worry about why because some people tend to dwell on it. Just understand that accounting information is based on cost. So this is what it looks like, right? When we first purchased the inventory, we had $1,200 of inventory available to sell, but we got a discount. It didn't really cost us $1,200. We got a discount of $24. So the inventory cost us $1,176. So the company now has inventory with a cost basis of $1,176. So our accounts are correct after that payment. Additionally, our accounts payable. Remember, we owed our supplier $1,200 after November 2nd because they gave us $1,200 worth of inventory, right? We paid them off November 12th. Some cash and some discount, but the total is $1,200, so it perfectly shows that we owe them nothing if we were to look in our books. And all of a sudden, our accounts are correct by doing that. Now let's move into the last two areas of accounting challenges when we are talking about being the purchaser, right? We're a merchandising company that is purchasing merchandise. So we're going to run through two examples here. Purchase returns, right? When we purchase inventory, but we want to return it for one reason or another. We're not happy with the goods, they're defective. Or another thing, which you may not have heard of in consumer life, but companies do this all the time, is an allowance. And you've probably experienced this at some point or another. It's the same thing. It's where you receive some defective or products that you're not happy with, and you call the supplier rather than sending it back to them. Call them and say, hey, look, I'm not happy with this. And they say, don't worry about it. You know what? We're going to reduce your price. We're going to give you an allowance and issue you some sort of a credit memo, right? Both are accounted for, fortunately, the exact same way, and both are really the exact same example. It's where we've purchased goods from our supplier, and for some reason, we're not happy with the goods. In one example, the returns, we're actually sending it back. In the other one, we're just calling and whining or bitching about the fact that we don't like it. So let's take a look at how to account for them. Let's assume, first with a return, we're going to use as an example, on November 15, we returned $300 of the goods to Trex Company because it was defective merchandise, okay? Alternatively, same example, let's say on November 15, we instead call and we issue a $300 price reduction for an allowance from Trex, right? Because we have defective merchandise. So we call Trex and we say, hey, listen, we're not happy with these goods. And they say, don't worry about it. We're going to reduce your price for $300. Effectively, it's the same thing for Z-Mart, right? We can throw away the defective goods in this example, but in this example, we actually have to ship it back to Trex. Let me show you how we account for it either way, right? Let's assume we purchase this, of course, on credit. Well, we no longer owe Trex, or we still owe Trex potentially, but we owe him $300 less, or the company $300 less, in both examples, right? We've returned $300 worth of goods in this, so we're going to pay them $300 less. And in this one, they said, don't worry, just reduce your price by $300. That's what I mean by a $300 price reduction or an allowance. So how do we account for it? Well, we're going to reduce the amount we owe. That's the account payable. We'll be getting debited by $300. And of course, our merchandise inventory has decreased in cost by $300. So we will reduce that asset account by $300. Again, our inventory has cost us $300 less. Now in the purchase returns example, we've actually shipped them physical goods back. In the second example where we're getting an allowance or they're giving us a price reduction, we've still got the same amount of goods, but it cost us less. And remember, that cost basis is so key. It's the cost principle. We record things at their cost, not at their worth, not at their number, not at their quantity, nothing except for cost. Keep it real simple. So let's review some of the accounting that we're going to be dealing with in purchasing. And I think this covers just about everything in three quick examples. Our company in number one here goes out and purchases $1,000 of merchandise on June 1st with the following credit terms. 2% discount if paid within 10 days. If not, the net amount is due in 60 days of invoice date. Remember, on the first purchase, we don't care about the credit terms. It, of course, tells me that credit was used, not cash, so I'm going to be, of course, crediting accounts payable, right, for $1,000. And what are we getting in exchange? Why are we taking on debt of $1,000 to the supplier? Well, we're getting merchandise inventory, of course. So that's what the first journal entry looks like. 2 days later, let's say Zmart returns $100 of the goods, right? Before we pay anything, it's just 2 days later, we say, hey, look, we're sending back $100 worth of the goods, take it off of our bill. So we owe our company $100 less, so we want to reduce the accounts payable by $100. We increased it by $1,000. How do we reduce it? We do the opposite. If we credited it here, we're going to debit it for $100. And same thing, we have $100 less of the inventory, right? So we've got to reduce our inventory. So it's really just the exact opposite, to reduce both those accounts by $100. Next, Zmart and by the way, had we kept the inventory, right, that we just returned, had we kept it and just called and whined and said, hey, $100 of this inventory just sucks, and they're like, don't worry, we want to keep you happy, you're a good customer of ours, just take $100 off the bill and you can do with that inventory what you want. Throw it away, sell it, give it to your kids, whatever. This journal entry would be exactly the same, right? We're reducing the amount we owe them by $100, and the inventory that we have, even though it's a different amount, cost us the exact same. So lastly, we're going to now pay on June 11th, right? We're going to pay off the full amount. We're going to get a 2% discount because we paid within the 10-day period, right? We purchased first on June 1st, and we're paying it off June 11th. That's within the 10-day discount period. We get 2% off. And remember, there's only $900 that remains at this point. So we need to show that we no longer owe our supplier $900. And if you're confused as to why it's $900, remember, first we started off owing them $1,000, but then we returned $100, so we reduced the amount we owed them in accounts payable by $100. So we owe them $900, and we're going to pay off the full amount now. So we're not going to owe $900. We need to debit accounts payable to get that balance to zero. And 2% discount of $900 is, of course, $18. We need to reduce our inventory because we didn't pay the full $900 for that inventory, and this is the only cash that we'll be sending their way. Hopefully that makes sense, and that is really the crux of purchasing. You're going to see in your chapter that they talk about FOB shipping point or FOB destination. These are really antiquated terms, very old, that are sometimes still used by shipping companies. All that FOB means, it's an acronym that stands for free on board, and what that means is that's where ownership changes hands, right? FOB shipping point means the moment that the goods are shipped, it's no longer owned by the shipper, it is owned by the purchaser. FOB destination means the shipper owns it until it gets to the actual destination. I will not give you any exam questions on this. My exam questions are going to be very simple, like this next example, but you do need to learn just the concepts. When there's transportation cost, I'll just tell you who's paying the cost. You don't have to figure out with FOB shipping point or FOB destination. The book is going to make you do it. Understand it just so you get a general knowledge of it. It is still used in some industry, and I want you to understand it, but understand I won't test you on it. I will do something like the example that you see here. Let's say Zmart purchased merchandise inventory, and we've got to pay the shipping transportation cost of $75 to get it to us. Well, in effect, that is part of the cost of the inventory, right? If I paid $1,200 plus $75 to get it to my store and have it ready for sale, then it didn't cost me $1,200. That inventory cost me $1,275. And I need to increase the cost of the inventory, not take an expense, right? In effect, that inventory cost me more. So when we are purchasing inventory, understand that shipping costs increase the cost if we're paying for it. If we're not paying for shipping costs and the seller is paying for it, well, then we don't have to worry about it. We'll deal with what happens when we are ourselves the seller in the next section, right? This is just a simple example of what we reviewed there. Basic concepts, right? It would be an itemized cost of our merchandise purchases. So let's assume that we purchased a whole heck of a lot of merchandise inventory. We would simply be subtracting out any discounts we got, any returns and allowances, and we'd add in the cost of transportation. Real key concept that we add in the cost of shipping and or transportation for it. Don't worry, you'll never have to do this itemization that I've put here. Just wanted to show you an example. And that wraps up the purchasing section, part 1 of chapter 5. The next thing we're going to move into is the selling part, which creates its own challenges. And we'll start that on the next video. We'll see you at part 3.